$87.42, down $15.58, a crushing 15.13% decline in a single trading session. If you're looking at your screen right now, staring at that red number, you are likely feeling one of two things: the absolute gut-wrenching panic of a bag holder who just saw a massive chunk of equity evaporate, or the predatory excitement of a value hunter seeing a generational entry point. It is Saturday, December 13, 2025. The markets are closed, the dust has settled on Friday's brutal session, and the silence is deafening. We are not just talking about a standard correction here. We are talking about a capitulation event that has shaken the confidence of everyone, from the retail trader on their Robinhood app to the institutional giants managing billions in Fidelity wealth management accounts. Yesterday, Oklo Inc. didn't just slide, it crashed through key psychological support levels, closing at $87.42, effectively wiping out weeks of gains and forcing the entire market to reevaluate the AI energy thesis. Expectation versus reality. This is the lens through which we must view this catastrophe. The expectation, the story that has been sold to you, to me, and to every investor piling into online investment platforms, is that Oklo is the chosen one. The narrative was perfect. Sam Altman, the godfather of modern AI, backing a nuclear fission company that would power the very data centers eating the world's electricity. The expectation was that as Nvidia stock climbed and AI demand skyrocketed, Oklo would be the inevitable beneficiary, immune to the gravity that pulls down lesser stocks. Investors believed that buying Oklo was essentially buying a call option on the future of civilization itself. But here is the cold, hard reality that hit the tape on Friday. Narrative does not keep the lights on, and it certainly does not support a stock valuation when the timeline for revenue gets pushed back. The reality is that the $1.5 billion at-the-market equity program announced this week signaled massive dilution, and the whispers about Oracle delaying their OpenAI data center build-out to 2028 have shattered the imminent revenue thesis. The disconnect between the hype of 2025's nuclear renaissance and the physics of regulatory approval has finally snapped back, and it snapped back hard. While you might have thought you were buying the next Tesla stock in its early days, the price action suggests the market fears you might actually be holding a speculative asset that ran too hot too fast. Let's analyze the anatomy of this drop, because if you are engaging in self-investing, you need to understand the mechanics of what just happened to avoid getting crushed again. Friday's session opened with immediate weakness. Pre-market trading on interactive brokers trading platforms already showed signs of distress, with bids disappearing before the opening bell. When the market opened, we saw a volume spike that indicated institutional distribution. That means the big players were selling while retail investors were likely still trying to buy the dip on their SoFi active investing accounts. The stock traded in a wide, violent range, touching an intraday high of $103.14 before the floor fell out, dragging it to a low of $87.34. It closed near the dead lows of the day. That's a bearish signal. It means that even at the very end of the day, no one was stepping in to defend the price. If you compare this volatility to Apple stock, which is often a sanctuary of stability, Oklo looks like a unicycle on a tightrope. This kind of movement is characteristic of high-beta pre-revenue growth names. We saw similar capitulation phases in Tesla stock back during its production hell days. But the difference here is that Tesla was producing cars. Oklo is still in the phase of producing regulatory paperwork and pilot programs. The 15.13% drop wasn't just panic, it was a repricing of risk. The market realized that the timeline for SMR deployment might be slipping, and in a high-interest rate environment, Time is the enemy of valuation. For those of you using Schwab Intelligent Portfolios or seeking investment help, you might be wondering if this is a structural break in the stock. The technical damage is significant. The $100 level was a massive psychological fortress. We spent weeks defending it. Bulls argued that as long as we held $100, the uptrend was intact. Friday's close of $87.42 didn't just break that support, it obliterated it. We are now in a no-man's land between the recent highs of $174 seen back in October and the lower support zones from mid-2025. The Relative Strength Index, RSI, has plummeted, but it hasn't quite hit oversold territory on the weekly time frame, suggesting there could be more pain before we find a bottom. The role of the retail investor here cannot be overstated. Robinhood stock trading data has consistently shown Oklo as a top holding among younger, aggressive investors. These are the believers in the Sam Altman halo effect. However, when a stock drops 15% in a day, margin calls start to trigger. If you are trading on margin within your Robinhood investment account or using leverage on Interactive Broker's account, Friday was likely a nightmare. We saw a cascade effect. As the price dropped, leveraged positions were liquidated, which forced more selling, which drove the price down further. This is the brutal feedback loop of a crowded trade unwinding. Comment below how many shares of Oklo you currently hold, and be honest, did you panic sell on Friday, or are you doubling down? Now, let's step back from the blood on the charts and look at the company itself to understand if this is a buying opportunity or a trap. Oklo is not your grandfather's nuclear utility. It is not building massive concrete cathedrals like the Vogtle plant. Oklo is designing the Aurora, a fast fission powerhouse. Unlike traditional light water reactors that use water to cool the core and slow down neutrons, Oklo uses liquid metal cooling and fast neutrons. This allows them to run on recycled nuclear fuel. That's the holy grail pitch, taking the waste from old reactors and turning it into clean energy for AI data centers. The business model is unique. They don't just want to sell reactors, they want to sell power. They plan to build, own, and operate these units, selling the electricity directly to end users like data centers or military bases under long-term power purchase agreements. This is why the SoFi robo-advisor algorithms and investing sites initially fell in love with the stock. It looks like a recurring revenue software model, but for energy. The problem, as highlighted by this week's drop, is that you can't sell power from a reactor that doesn't exist yet. The Nuclear Regulatory Commission is notoriously slow, and while Oklo has had some wins, the timeline for commercial operation is the biggest risk factor. This brings us to the Oracle news that likely contributed to Friday's sell-off. Rumors swirled that Oracle, a major potential partner for AI infrastructure, is pushing back its aggressive timelines for nuclear-powered data centers. If the customers, the hyperscalers, are delaying, Oklo's revenue ramp gets pushed to the right. In financial modeling, a dollar earned in 2028 is worth significantly less than a dollar earned in 2026. Fidelity investment analysts and those managing Fidelity mutual funds run these discounted cash flow models daily. When they adjust the start year of revenue from 2027 to 2029, the net present value of the stock crashes. That's exactly what the algorithm-driven sell-off on Friday was reacting to. Furthermore, we must address the $1.5 billion ATM offering. For those new to online investing, an at-the-market offering allows the company to sell new shares directly into the market to raise cash. It's great for the company because it fills their war chest, but it's terrible for the stock price in the short term because it dilutes existing shareholders. It essentially increases the supply of shares while demand is shaky. If you are holding Robinhood fractional shares in your brokerage account, your slice of the pie just got smaller. The market is asking, why do they need $1.5 billion now? Is the cash burn higher than expected? Are there hidden costs in the Idaho pilot project? Let's talk about the competition, because Oklo does not exist in a vacuum. You have NewScale, you have TerraPower, Bill Gates' company, and you have the massive utility giants. When you use Fidelity ETFs or look at Fidelity brokerage research, you will see that many conservative funds prefer the regulated utilities over speculative plays like Oklo. However, Oklo's advantage was its speed and its size, literally. The Aurora is small enough to be factory fabricated, but if that speed advantage is eroded by regulatory delays, the moat shrinks. Despite the carnage, the contrarian take, the reality that might exceed expectations,